CVS is down 5% at the market open. It is heading towards its 52-week lows. Is it undervalued? Are we looking at a company at a very good price for strong upside? Let's find out today. Let's jump into their income statement. Let's see how well their revenue as well as their bottom line net income is progressing year on year. Let's have a quick look at the health of the company, total cash versus total debt. We'll also analyze them versus some of their competitors on a total return basis over the last 5 years. And we'll take a closer look at that dividend safety as well as their financial metrics for the future. We'll have a quick look, run them through the insider buying and selling screener as well as the institutional buys and sells quarter on quarter. And as always, we will run them through our valuation model to get to the intrinsic value as well as the acceptable buy price given that investor margin of safety, and we will touch upon Wall Street forecast and their price target over the next 12 months. So let's jump straight into the analysis. Now it is down around 4 to 5%. We did have this off the back of the Humana news. If you want to find out more, do check that episode out. We just ran through that a few hours ago. Now it is down 14% over the last year. We can see a forward PE of 8.6 with a yield inching closer and closer to 4%. Now if you've held this over the last 10 years, you would be up around 10%. Now it doesn't include those dividends reinvested, but that is a pretty poor return on any investment, and their all-time highs were pretty long ago, 2015 at around $113, although we did see it touch nearly about that at the beginning of 2022. In terms of the top line revenue, what we like to see, 3 to 7% growth year on year. December 2018, 194 billion reported. December 2022, 322 billion. So strong growth over the last 5 years. In fact, when we do a granular analysis, we can see increases year on year, which is always very positive to note. And on top of that, based on their December 23 annual report, which is yet to be released, we are expecting an increase again to 347 billion. So lots to like there based on their top line. What story does their bottom line net income tell us? Well, they reported a net loss in 2018, 594 million. And then when we take a look at December 22, 4.1 billion reported as a profit. So that is positive news. It did turn from a net loss to a profit. But on a more granular level, we see an increase all the way to 21 before a drop in 22. And in more positive news, 2023 is expected to be higher than the previous year and higher than the previous high over the last 5 years. So overall looking positive for CVS shareholders based on the income statement. Quick health check, total cash versus total debt. What we can see here, total cash and short-term investments, 6.6 billion in 2018, 16.2 billion in their latest quarterly report. So they are sitting on a ton of cash right now, especially compared to the last 5 years. In terms of their total debt, numerically and directionally, we can see it increase from 73 billion to 80 billion. So we will touch upon that when we do analyze the dividend safety and talk about that net debt to EBITDA metric. Now, quickly going through the healthcare services, companies in a similar sector and size, Cigna Group, Laboratory Corporation of America, as well as a few others. Now, this includes those dividends reinvested. CVS, the worst performing, down 13%. When we extend that to the last 5 years, we see it is up positive 29%, but it is one of the worst performing of the group. Now, as always, just because it has performed poorly over the last 5 years, it doesn't necessarily mean past performance is an indicator of future, but as always, we add it in. In terms of looking at insider buys or sells, well, over the last 3 months, we see the director did buy 2,000 shares at around $70, not far off the current trading price, for around $141,000 total cost. Now, this is a bullish signal in my opinion whenever we do take a look and we see the analysts, or not in fact analysts, when we see insiders at the director buying, it gives us faith that management are expecting the share price over the long short term to increase. So this is very, very bullish. Bearish when insiders sell, not necessarily. We don't have any of that signals over the last 3 months. But as we always say, insiders do sell for many reasons, including personal and financial. Now, institutional ownership, 76%, as we can see here. Just under 10 billion of sales by these institutions over the last 12 months. The same period, 12 billion worth of buys. So we can see they have been buying more than they have been selling. Although we do know in Q2 of 2023 and Q3, there have been more sales by the institutions than buying. And in Q4, we see pretty much thereabouts in line as the same. So yes, overall institutions have been buying more than they have been selling. Now, in terms of the dividend safety, 90, very safe. That is a good looking score. Market cap, 96 billion, a large cap company. In terms of key recessionary metrics, well, they increased the dividend during the last recession. Above average growth, negative 2.5% versus the S&P's negative 12%. And they also outperformed the S&P negative 38%, with the S&P's return coming at negative 55%. One thing we love to see, and we saw it a few weeks ago, was that dividend increase 9.9% in December 23, well above that minimum 4% we advocate on the channel to keep up in line with inflation. 2% pretty poor over the last 5 years, but over the last 20 years, double digits looking very, very strong on average. We do also note they have only increased those dividends for the last year, as when we do take a look, there were many years where they did maintain that dividend, in fact from 2017 to 2021. Now, in terms of dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Do keep in mind, though, we don't look at any of these models in isolation, and we will draw conclusions towards the end. And we can see here the forward PE, 8.5, below the 5-year average of 9.9, another sign of undervaluation. Comparing it to the sector, well, healthcare sits significantly higher at 17.9. Now, as always, earnings is susceptible to manipulation by management through accounting. Free cash flow is what I'll draw your attention to. Personally, I say below 60%, but some people can bring that down to 40% for their preference for industry specific. Well, over the last 10 years, in fact, it's been well below 40% and 60%. 2023 expected 27%, 2024 33%. So I would like to see another strong high single-digit dividend increase from CVS Health this year. 312 as the free cash flow in 2013, 1030 in 2022, more than 3 times growth over the last 10 years. Two things to note. Firstly, pretty inconsistent. We're not seeing growth after growth after growth. And also from 2021, it did drop in 22 and is expected to again in 2023. So just a few things to consider. Sales growth, top line, it isn't double digit every single year, but for the large part, it has been very strong growth to that top line. 2023 at 10% is looking very healthy. And we can see they have increased their top line more than twice or 2 times, from 127 billion to 347 expected in 2023. Well, they've done quite a bit of share outstanding movement. They have returned excess cash to investor pockets from 2013 to 2017. But from that point on, they did dilute your position by issuing shares. And we can see the net position has been a share dilution from 1.23 billion to 1.3 in 2023. ROIC, honestly, 10% or more is what I look at. Otherwise, I do get turned off when analysing stocks. If it's not at 10%, it signals to me that management aren't able to effectively allocate their capital. 2022 at 11% is strong. 2023 at 9% is okay. I would like to see it back up to 10% or more. But we do note that from 2013 to 2017, they did have some strong years of return on invested capital metrics. Operating margin and free cash flow margin both leave a lot to be desired. We would like to see it at 10% and 6%. And one thing I would say is a red flag indicator for CVS Health. Their operating margins have been decreasing over the last 10 years, as you can see with 2023 at 4%. I would look very closely at 2024's annual report to ensure they have started to increase and not continue to flatline or drop. Same story with the free cash flow margin. It has dropped down to 3%, which is a little bit of a worry. I would like to see this up to the 5-6% level. Finally, on the metric side, the net debt to earnings before interest, tax, depreciation, amortization, 2.38. This is the number of years it would take CVS to pay all of their debt net of cash on hand. Remember, this metric shows us the balance sheet strength as well as dividend safety. 2.79 is expected to increase in 2023. So again, something just to monitor. We don't really want to see it go above 3. But so far, it looks like the dividend is safe and the balance sheet does look under control. Now, let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we jump into the valuation, just to let you know, we have recently started a free weekly newsletter. If you want to sign up, it's completely free on the pinned comment below. Last week's episode was on the 7 golden dividend metrics, where we run through the screener on how to find undervalued stocks. This week, we are using this screener to find a very undervalued stock with some nice upside in the future. So let's jump into the model. The first one, we have Graham's valuation. We have CVS EPS, their long-term growth, and the AAA corporate bond yield. And we can see the intrinsic value is showing a sign of overvaluation. But do bear in mind, we don't look at any of these models in isolation. We will draw our conclusions towards the end. We then have the multiples valuation model with the P multiples, the average P multiplied by that of CVS to get an intrinsic value of $131. Some nice signs of undervaluation based on that market value. We then move on to the dividend discount model with the yearly dividends. Now, average growth at 6% isn't too bad. Forward looking, we've gone slightly less at 5%. This gives an intrinsic value still showing undervaluation, which is looking fairly strong right now. Finally, we get to the DCF model with the free cash flows year on year. Average growth rate 18%. We've been pretty conservative at 0%. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get an intrinsic value of 115. Again, our third signal of undervaluation. Now, for today's episode for CVS Health, the intrinsic value is the average of these four models, coming to $99.31. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment below. So typically we use a 10% margin of safety if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see it is a buy. At 15%, an acceptable buy up to $84. At 20%, a buy up to $79. At 25%, still showing signs of a buy. And we can see at 30%, it would have to be trading at around $69.52. So it isn't too far off. So right now, we believe it to have around a 25 to 30% margin of safety. In terms of Wall Street, well, they have a price target of $93 over the next 12 months. So they do see upside of 30%. As always, do let me know your thoughts in the comments below. Is CVS Health one you are looking to add with the drop that we did see today of around 4 to 5%? We also note that the yield is heading towards 4%, which could look very attractive for investors. As always, if you enjoyed today's episode, smash that like button, hit the subscribe and bell button. We will see you on the next episode. And as always, take care for now.